If you've owned apartments, retail centers, or other investment real estate for a long time, there's a good chance you've built substantial equity. Maybe you've spent 20, 30, or even 40 years acquiring properties, increasing rents, paying down debt, and watching values appreciate. Today, you may be sitting on millions of dollars of equity, but you're also at a point where the question is no longer how to build wealth. The question is how to enjoy it. Many investors reach a stage where they no longer want calls about maintenance issues, tenant disputes, vacancies, insurance claims, or capital improvements. The properties that help them create their wealth may no longer align with how they want to spend their time. They still want the income, they still want the benefits of real estate ownership, they just don't want the day-to-day responsibilities that come with active management. At the same time, simply selling and cashing out often isn't an attractive option either. After spending decades building wealth and deferring taxes, many investors aren't excited about writing a large check to the IRS. They'd like to simplify their lives, access more passive income, and preserve the wealth they've created without triggering a significant capital gains tax event. That's exactly why so many investors begin looking at Delaware Statutory Trust and triple net investments as potential solutions. Both a Delaware Statutory Trust and a triple net investment can provide passive income, work within a 1031 exchange, and help simplify ownership. As a result, most investors tend to focus on the projected returns. They compare cap rates, cash-on-cash returns, and property types, and while those are certainly important considerations, I think many investors overlook a much bigger question. What happens if you want to access your money? When investors compare a DST to a triple net property, they often assume that income is the most important part of the equation. In many cases, the projected returns may actually be fairly similar. What often gets overlooked is flexibility. For example, what options do you have if 5 or 7 years from now, if you'd like to access some of that equity you've built? That's where the differences between a Delaware Statutory Trust and direct triple net ownership become much more significant. Life happens, and maybe you want to help a child buy a home or assist with a grandchild's education. Maybe healthcare needs change or family circumstances evolve. Or maybe after spending decades building wealth, you'd simply like to access some of that equity you've already created so you can travel, spend more time with family, and enjoy the lifestyle you've worked so hard to build. That's where one of the biggest differences between a Delaware Statutory Trust and direct triple net ownership begins to emerge. Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker and real estate advisor. Today we're going to discuss one of the most important overlooked advantages of direct triple net ownership and why many experienced investors view a triple net property not just as passive income investment, but as a long-term liquidity strategy as well. Let's use an example from a situation I see all the time. An investor spends 30 years building wealth through apartment buildings or other investment real estate. They increase rents, pay down debt, navigate market cycles, and gradually build substantial equity. Eventually, they wake up one day with a real estate portfolio worth millions of dollars and start asking a different question. What's the easiest way to keep the income without all the work? On paper, they may have several $million of equity, but much of that wealth remains tied up in the properties they own. They don't necessarily want to sell and trigger a significant capital gains tax bill. At the same time, they're ready to retire from the responsibilities that come with active ownership. The maintenance calls, tenant turnover, rising insurance costs, capital improvements, and the countless issues that seem to come with managing real estate. That's why many investors ultimately decide to complete a 1031 exchange. They sell a management-intensive property and exchange into something more passive. That's usually where the conversation shifts towards either a Delaware Statutory Trust or a triple net investment. And at first glance, both appear to solve the same problem. But beneath the surface, they're very different investments. One of the reasons I think investors get confused is because both the Delaware Statutory Trust and triple net properties are often marketed as passive investments. And that's true, but the ownership structure is completely different. When you purchase a triple net property, you're buying the real estate itself. So you retain control over the major decisions. If an opportunity comes along and you'd rather exchange into a different property, that's your choice. If you decide you'd like to refinance and access some of that equity you've built, that's also an option. If you want to hold the property for 5 years, 20 years, or ultimately pass it on to your children, you have that flexibility. In many ways, you've simply traded a management-intensive property for one that's significantly more passive, while still maintaining the benefits and control that come with direct ownership. A Delaware Statutory Trust is different. Rather than owning a property directly, you're purchasing an interest in a trust that owns the real estate. The sponsor is responsible for many of the major decisions, including how the property is managed and ultimately when it is sold. For some investors, that's exactly what they're looking for. They don't want the responsibility of ownership. They simply want passive income and professional management. It's also important to understand that Delaware Statutory Trusts are designed with an eventual sale in mind. While every DST is different, many sponsors target a holding period of roughly 5 to 7 years before selling the property. When that sale occurs, investors typically receive their share of the proceeds and must decide what to do next. If they want to continue deferring taxes, that often means identifying another replacement property or a DST and completing another 1031 exchange. And that's where things can become challenging. None of us know what the market will look like 5 or 7 years from now. Interest rates may be higher, cap rates may be lower, inventory may be limited, quality replacement properties may be difficult to find. Yet when a DST is sold, investors are often faced with making another investment decision, whether the timing is ideal or not. Whereas with direct ownership, you have full control over that timeline. And that control creates opportunities that simply don't exist in a Delaware Statutory Trust. One of those opportunities is the ability to access some of the equity you've built without selling the property. Let's assume an investor sells an apartment building through a 1031 exchange and purchases a triple net property all cash. The tenant is responsible for taxes, insurance, and maintenance, while the investor collects the rent and enjoys a much more passive ownership experience. They preserve the income and the benefits of real estate ownership, but left behind the management burden that comes with apartments and other actively managed properties. Now let's fast forward 5 years. The property is performing well and everything is going according to plan. At some point, however, the investor decides they'd like to access some of that wealth they've spent decades building. Most people assume their only choices are to either keep the property or sell it. But because they own the triple net property directly, there is another option. In most instances, they're able to refinance the asset and pull cash out while continuing to own it. The rental income can continue. The property remains in the portfolio. The investor can continue to benefit from future appreciation. And because they're refinancing rather than selling, they aren't triggering a capital gains tax event. While investors should always consult with their CPA and tax advisor regarding their specific circumstances, loan proceeds themselves are generally not treated as taxable income because they're borrowed funds that must ultimately be repaid. So now the investor has gained access to a portion of the equity that was previously tied up inside the real estate. And that's the part many investors overlook. The refinance isn't really about borrowing money. It's about creating flexibility. It's about converting a portion of your paper wealth into usable liquidity without giving up ownership of the asset you've spent years building. What I've discovered over the years is that most investors never actually exercise this option. The value isn't necessarily in the refinance itself. The value is in knowing it's there. It's the peace of mind that comes from having access to your equity if you ever need it, without being forced to sell the property. Typically, when investors are in their 40s and 50s, they're often focused on building wealth. By the time they reach their 60s and 70s, the conversation frequently shifts. It's less about accumulation and more about flexibility. They want to know they can access capital if circumstances change. As we talked about earlier, maybe they want to travel more, or they want to help children or grandchildren, or maybe they simply think about the realities that come with aging. None of us know what the future holds, but an unexpected medical diagnosis, long-term care needs, assisted living expenses, or a health issue affecting a spouse can create significant financial demands at exactly the wrong time. Even investors with substantial net worth often find comfort in knowing they have access to liquidity if life takes an unexpected turn. Maybe they never use it, but there's real value in knowing it's there. That's what makes the cash-out refinance strategy so powerful. The investor hasn't given up the income stream. They haven't sold the asset. They haven't triggered a large taxable event. They've simply unlocked a portion of the equity they spent decades building. And in my experience, that's often the difference between being wealthy on paper and actually having the flexibility to enjoy some of the wealth you've created. And this is where one of the biggest differences between a triple net investment and a Delaware Statutory Trust become apparent. As we discussed earlier, when you own a triple net property directly, you own the asset. That ownership comes with control, flexibility, and options. If circumstances change, you have the ability to make decisions regarding the property, including whether to sell it, hold it, exchange it, or refinance it. A Delaware Statutory Trust is completely different. When you invest in a DST, you're investing in a structure that was intentionally designed to be passive. For many investors, that's one of the primary attractions. The sponsor handles all the major decisions related to the investment, including financing, asset management, and the eventual sale of the properties. Investors can enjoy passive income without having to actively oversee the asset themselves. The trade-off is that you also give up a significant amount of control, and that's where the cash-out refinance conversation becomes important. Because investors do not own the underlying real estate directly, a DST investor cannot simply decide they would like to refinance the property and access a portion of their equity. That flexibility doesn't exist within the structure. The equity remains tied to the investment until the property is ultimately sold by the sponsor. For investors whose primary objective is maximum passivity, that may not be a concern. But for investors who value flexibility and optionality, it's an important distinction to understand before making an investment decision. So who is a Delaware Statutory Trust best suited for? In my opinion, it's best suited for an investor whose highest priority is simplicity. They don't want decisions, they don't want involvement, they don't want financing discussions, they don't want to think about the real estate. They simply want passive income and professional management. There's absolutely nothing wrong with that. That said, I don't want anyone walking away from this video thinking Delaware Statutory Trusts are risk-free investments. They're not. Like any investment, they come with their own set of risks and trade-offs, including sponsor risk, financing risk, real estate market risks, and liquidity limitations. Those are important topics, but they're beyond the scope of today's discussion and something I'll address in other videos. For the purposes of today's conversation, however, we're focusing specifically on one issue: flexibility. More specifically, the ability or inability to access your equity after you've made the investment. A triple net investment tends to appeal to a slightly different investor. They still want passive income. They still want to step away from the tenant calls, maintenance issues, rising insurance costs, and day-to-day responsibilities that often come with apartments, retail centers, and other management-intensive properties. But they aren't necessarily ready to give up ownership altogether. They like the idea of still owning the real estate and having control. They appreciate knowing that if circumstances change, they still have options. And that's really what this comes down to. Both investments can potentially provide passive income and can help simplify your life. The difference is that one prioritizes convenience while the other prioritizes flexibility. So the real question isn't which investment is better. The real question is which one better aligns with your goals, your personality, and how much control you want to maintain over your wealth. Do you value maximum convenience or do you value maximum flexibility? Neither answer is right or wrong, but they are very different strategies. Here's my take. When investors compare Delaware Statutory Trusts and triple net investments, they often focus on projected returns. They compare cap rates, cash-on-cash returns, and projected income. And while those factors are certainly important, I think they're only part of the story. The bigger difference is the flexibility, the ability to decide when to sell, how long you want to hold an asset, and the option to access equity through a refinance. A cash-out refinance is just one example of the additional flexibility comes with direct triple net ownership. There are other advantages, trade-offs, risks, and considerations as well. In other videos, I discuss topics such as estate planning, liquidity, control, and what is known as the 7 deadly sins of Delaware Statutory Trust investing. And that's why I believe investors should think beyond income when evaluating these structures. The question isn't simply which investment generates the highest return. The question is which structure best aligns with how you want to live, how much control you want to maintain, how important flexibility may be to you in the future, and whether you fully understand the risks and trade-offs associated with each approach. Because if there's one thing I've learned from working with investors, it's that the value of flexibility tends to increase as life goes on. And before investing millions of dollars through a 1031 exchange, I think that's a conversation worth having. And if you're actively evaluating Delaware Statutory Trust, triple net investments, or you're in the middle of a 1031 exchange, I also offer a free guide called the Top 10 Questions Every Investor Should Ask Before Investing in a DST. It's designed to help investors look beyond the marketing brochure and better understand the fees, risk, control considerations, liquidity limitations, and long-term trade-offs before making an investment decision. If you'd like a copy, you can reach out through the link in the description below. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room, and I'll see you in the next episode.